Our first topic in term 1 has to do with income statement. Remember, this is not new to you. We introduced it in grade 10, income statement. Now, when we go to grade 12, term 1 expects to do financial statements about companies, okay? In grade 10, you do solo trade accounting. Then grade 11, we do partnerships and manufacturing accounting, as you saw. Then grade 12, this is where I will introduce you to companies financial statements. Now, a company is a form of ownership, okay? Which is required to publish its financial statements. Remember, public companies, by law or by the Companies Act, they are supposed to publish their financial statements. Now, in grade 12, term 1, we start with companies' accounts. Okay. Now, some of the statements we prepare in grade 12, we have the income statement. Okay. Remember, we say the income statement, by the way, we are going to first do the class, the notes. Now I explain to you. Then after that, we shall do a question which comes from the income statement. Right. Now, we are saying the income statement reflects the trading results in the form of profit or loss. Remember, the name changed nowadays. It's called the statement of profit or loss and other comprehensive income. Okay. So those days back, we used to call it an income statement. So when you go to the question paper and the examiner is asking for the statement of profit or loss and other comprehensive income, please, he's meaning the income statement. Right. Now, remember, what is this statement for? We say the statement is, we use it to determine whether the business made a profit or a loss. Okay. Now, I'm going to take this first minutes to go through the format. Those who did, you did an income statement in grade 11 for partnership accounts, for a partnership business. Now, it's the same income statement, but we add in some other things, right? We add in some other things, a few items which pertain to the company and which don't pertain to the partnership business or sole trade business. But the principles are the same, which we follow. Right. Now, when we go down here in our income statement, already I've said that an income statement, actually here they are reminding you that in grade 10, you prepare the financial statements for a sole trader. Yes. Then in grade 11, partnerships, and then grade 12, we do companies, as I've explained to you already. Now, we have the trading section in our income statement, okay? And we have the other section here. We have another section here, operating expenses, and we have another section here. So you need to know what happens in the income statement, which section and which one. I've seen students mixing up work. Expenses, they put them under income. Okay. Remember, according to the International Financial Reporting Standards, this statement is prepared by the IFRS, International Financial Reporting Standards. It's not us, or it's not your teacher who come up with this structure. No. It is, we are following international standards. So the format is supposed to be the way it is. If, for example, you bring expenses and put them here, okay, you are wrong. Expenses are supposed to be in their section, as we shall see, and that. So the first thing you must understand, actually in your exams, they draw for you the format, but some of the items, as we shall see in the questions, that they put for you some items and then they want you to record some other items there. Okay. Now, let's start with the sales. Sales Okay, the trading section, remember the trading section represents the sales and cost of sales. Okay, sales and cost of sales. Now, sales, this is the amount we get from selling our goods. Okay, those are our sales. Okay, then, for example, if we sell and we get 1 million, okay, let me do some writings in here. Let's say we sold our goods and got 1 million. Okay, we had sales for 1 million rand. Okay, now these are our sales here. Okay, 1 million rand. Let's say we made sales and we got 1 million rands. Okay, 1 million. Just a moment here. I'm just going to give you some figures here. Okay. Okay. We are saying we made sales and got, let's say, 1 million rands. Okay. Then sales is what we receive from our customers, or what we expect to get from our customers after selling, right? Then we remove the cost of sales. We shall see how we adjust that figure. For example, with the sales returns and the like, we shall see how to adjust it. Let's say we sold some goods and then some goods were returned, okay, to our customers. Let's say of 1,000 rand, so we shall need to subtract it from our sales figure here. And then the settlement discount granted, if we give them a discount for paying on time, we also subtract it from here, right? Then this cost of sales here, we want to determine how much did we buy our stock we have sold. That is cost of sales. Let's say we bought our stock for 500,000, okay? 500,000. So that's why this figure is in brackets. So we shall, brackets in accounting, remember they mean we are subtracting, okay? So after subtracting it, how much is left? We are going to be left with 500,000, okay, which is 500,000, right? Now, that 500,000 will be our gross what? Profit. This minus this, we get our gross profit, which is 500,000, okay? We shall see how we adjust these items as we proceed in the questions, but for now we are seeing the structure. Now, after deducting that, now we have our gross what? Profit, which is this here. The 500 is this XXXX. Now, the other section, now this section, this one is called the trading what? The trading section, which is this. So what is the trading section for? We get our sales minus our cost of sales. Okay. Now, we go to other operating what? Other operating income. Other, there is a word other. Other means that we are looking at some other income which the business may receive, but we don't have, which the business can receive, but not from our daily business operations. Let me give you an example. We can have, let's say, a grocery store, like a ShopRite, okay? Or let's say a grocery store, a furniture store. Let me use a furniture store. Now, a furniture store is selling furniture, okay? A furniture shop. Now, a furniture shop is dealing in selling furniture, fine. But you find that sometimes this furniture shop has got, maybe it sold some of its vehicle. Maybe the vehicle was tired, it was old, and then they sell it off. Now, do you see that the business is going to receive somewhat, some stock, sorry, some income. But this income is coming from where? It's not coming from the business operations of the business, no. It's coming from other sources, but not from selling its furniture. So the income from selling furniture would be this sales, which is this one, sales. This one comes from selling the furniture if it's a furniture shop. But now, other operating income, this is some other income which may come to the business, but not from its normal business what? Operations. Okay. Now, so I said this is 500,000. Okay. Now, look what the examples we can give here. Discount received. What is this? This is when we buy stock from our clients, okay? Sorry, from our suppliers. And these suppliers, they give us a what? A discount. For example, we bought stock we were supposed to pay them maybe we are supposed to pay them maybe 10,000, okay? 10,000 rands. And then because maybe we paid on time or we bought too much stock, they say, no, we are giving you a discount, okay? A discount, then it can give us maybe 1,000, which means we are going to pay them only 9,000. So do you see that this 1,000 now we are receiving, for example, the 1,000, because I said we are supposed to pay them 10,000. Now we are giving them, they are giving just a discount of 1,000. So this discount of 1,000, which means now we are going to give them only 9,000. That's what we are going to pay them. So when we pay them 9,000 and we receive a discount of 1,000, this one is discount received. Who is receiving this discount? Our business is receiving the what? The discount. Okay. Remember I said that we have discount received and discount granted. Discount granted, we are granting it to our customers and it will reduce this figure as we shall see when we proceed when we are doing our questions. Now we have the rent what? Rent income. What is this? This is also other income. Rent income, let's say we have our building, okay? And we are not using the whole building for our business. So we can get some part and give it to some other tenant, okay? So this tenant is going to give us what? We'll be paying us money in form of rent. We'll be giving us rent money. So to our business, this is income to us, okay? But yes, remember we have rent income. Even here in expenses, we shall have rent, okay? We have rent income and rent expense. Rent income is coming to us. The income is coming to our business. But rent expense, we are paying rent to our landlord, okay? So rent income, it means that the business, as I've explained, we are subletting the what? Part of our building. So this person is giving rent to our business. Then profit on sale of asset. Yes, this one I explained. This is the first thing I gave you an example with. It's an asset. It can be furniture, vehicle, equipment, etc. All the assets we know, the non-current assets especially. Those assets, when we sell them off, when we sell those assets off, it means that, remember we are looking for the word profit. Do we make a profit on selling this asset? If we are making a profit, it will be our income. Remember, if we make a loss, you see the loss here, I'll explain it, but I want to bring it here. Loss on sale of asset means that we are losing money. We are making a loss. But profit on sale, it's income to us. If we make a profit, which means we are selling more than its book value. Okay? Then we have the what? We have, okay. We are saying, yeah, the loss will be an expense to us. Then we put it here. But this one, the profit will be our income, but other income, that's why I highlighted it here. Then bad debts recovered. What is this? We have bad debts, 2 words here, bad debts, 3 actually, bad debts and recovered. Now, what's a bad debt? A bad debt Sometimes we call it a credit loss. Actually, credit loss will be our expense. Now, a bad debt or credit loss, this is where our client or our customer failed to pay. We sold the goods to them on credit, but now they failed to pay us. Okay? So when they fail to pay, what do we do? When they fail to pay, what we do? We can write them off. Writing them off meaning that we forgive them to say, okay, we shall not recover this money, and then they leave it. Or some of them, they disappear, okay? Anything can happen. So, if they disappear this year, or they disappeared last year, let me say they had disappeared last financial year, okay? Now, what happens? We wrote them off last year as a bad debt, okay? Now, I'm explaining the word recovered now. Recovered. We wrote them off last year as a bad debt, but now this year they are coming to pay. Maybe the customer was not in the country, had gone overseas. Now he's coming back and remembering, oh, I had to pay these people. Okay, so what am I supposed to do? Hey, they come and pay. Should we refuse the money? No, it's our income. But this income, remember, does not apply to this year. And two, by the way, it was for last year. Two, last year we had written it off to say no, they will not pay. Okay, so what are we supposed to do? Should we refuse the money when they come and pay? No, it will fall under other income, and we say bad debts recovered, because we are recovering this what? This income from our debtors. Then provision for bad debts adjustments if increased. Okay, we shall see this. This is bad debts adjustments. This is also, so the other thing they are saying, ETC, we can have other operating income, operating income like commission income. If we are selling a goods and we are receiving a commission, it will fall under this what? And under this section, okay? So any income which the business receives, talk about interest income, interest income goes here, sorry for that. But dividends, if we receive dividends, we shall see them. So all that income will come under other income. So we shall see that as we do what? As we proceed, okay? Right. Now, this section, what do we do? All the items, all these items you see here under other income, we add them together. When you see this thick line, this thick one, this one, the black thick line, it means that all these items must be added together and we put the total on top. Okay, so this total you see here, this one, it's coming from the addition of all these amounts, and then we put the total. Okay, so what do you do in the income statement? Don't put their rent income if your information given to you, the question given to you, there was no rent what? Income. Okay, you write what is given to you. You write what is given to you. Okay, so don't include what is not written to you. Then after getting our other operating income, we add it to, let me show you here. We add it, remember here we had our gross profit, okay? Then we add it to this total we have got here after adding. So these two, when we add them together, okay, this plus this, it gives us this, okay? We get the gross. These two, when we add them together, we get the gross operating income, okay? So with the gross operating income, it includes these two sections, trading section and operating income. Then that's where we get this total here, okay? Then after that, we have another section known as, the other section is known as operating expenses. The word operating, we are looking at the expenses we incur during the normal business what? Operations, okay? The normal business operations. Those are what we call the operating expenses. So expenses, remember, you cannot run a business without incurring expenses, okay? And remember, the meaning of an expense means paying out money in order to run your business. So they have given us some examples. We have a lot of expenses: advertising, salaries and wages, insurance, provision for bad debts, sundry expenses, rent expense. Some of them are not listed here. Talk about rent expense, talk about depreciation, talk about, actually here they said it is stationary, when you buy stationary. So all the expenses, whenever you see that the money here, the business here was paying out money, okay? And this money has to do, this expense has to do with the normal business operations of the normal business operations, then you have to do it as a what? An expense, okay? It has to be recorded under expense. So what you need to find out, was the business paying out money, or it was receiving what? Sorry, was it the business giving out money or not? Okay. Right. Now, look at, for example, advertising. This is an expense. Salaries and wages, insurance. Remember, this is just an example. Insurance. So advertising, when you pay for advertisement, okay? You want to advertise your business so that people know it well. So you have to pay money. For example, you go on radio and put an advert there. You have had advertisements on the radio, the billboards, okay? When you're driving on the road, those billboards you see on the road, they are not there for free. You have to pay the government, okay? For putting your flyers, maybe you give out flyers, the money for printing flyers for your business. That is all advertising, okay? TV adverts, you know, there are so many ways of advertising. So whenever you advertise for your business, for us, we write it as an expense. Then salaries and wages, this is the money you pay your employees, okay? The money the business pays its what? Employees. Now, this amount must also be written under operating expenses. Insurance, okay? You find that your business is insured, okay, for any risk. So when you pay for insurance, then it's also an expense. Provisioning for bad debts, adjustments, we shall explain this. When we do it, this is provision. Actually, provisioning for bad debts means let me explain this now. For example, what businesses do, they always put money aside to cater for the bad debts, okay? Remember, I talked about the bad debts. So if let's say we put 1,000 aside to say, oh, our customers, according to our experience, customers may fail to pay 1,000 in total. So what the business does, it puts money aside to say, okay, if these customers fail to pay, I'm going to do what? We are going to use this 1,000 to balance or let me say, I can use another word and say, to pay for them on their behalf. So we are going to use this money and cater for those customers who may fail to pay us, okay? So if the business puts money aside, if we increase this bad debt, then it means it's an expense to us. But if it is decreased, the provision, by the way, if it is decreased, I want you to take a note of this word, please. Provision. A provision is like putting an allowance to say, okay, we expect this. Let's put this figure aside, okay? We are not saying that they have not paid, yes, but we expect them not to pay. So if this amount is decreased, let's say, let me put you here. Let's say the provision was 1,000, okay? Then we say, no, we are changing the provision. Now it is 800, okay? Now, do you see that the amount you had put aside, please, I don't want this one to confuse you. It's not part of our, let me remove it. It means that the amount we had put aside, we had put aside 1,000. Now we are putting 800, okay? Which means there is that difference of 200. If you subtract these two, the difference of 200, this difference means we have to do what? It's our income now. We no longer put that provision, okay? It's our income, so we put it where? It will be our income now. That's why we put it here. Now, if it is increased, let's say here it was 800, the provision. Now we say, no. Hey, debtors are increasing in our business. Let's add on another 200 to make it 1,000. Now it will be 1,000. Now, this 200 we have added on again. Here it will be an expense to us because we are likely to spend more money than what we had expected. So that's how I can explain the provision for bad debts. If it's an increase, it is an expense. The difference, the increase is an expense. If it's a decrease, then it's income. Then the bad debts, I've already explained them. Bad debts, this is where we have, these are the debts which have gone bad. Or sometimes some books, they call it credit loss. During this financial, these ones we have confirmed that these people, we have written them off this financial year, okay? Then sundry expenses, these are expenses which don't take always, which are not common, okay? We call them sundries. Remember your cash receipts journal and cash payments journal. We have expenses which are always what? Which we have their expenses which don't take, like which are not taking place normal on frequently, sorry. So those ones we call them the sundries. Now, sundry expenses, also put them here. Then we have, they're saying these are new expense accounts unique to companies. Which ones? We have the audit fees. Now, audit fees, remember, by law, all public companies must be externally audited by an independent auditor. You people, if you have to go to university, you will do auditing there. But even here, we do some questions in auditing, just a few. Anyway, but if you are, the auditor, if the auditor comes, the company must pay for audit fees. So the audit fees which we paid for the year, they will be recorded where? They will be recorded under this line, audit fees. So we call them new expense accounts unique to companies, meaning that we don't have these. We don't have this in solo trader, and we don't have this type of accounts in this type of expenses in partnership, because remember, partnerships and solo trade businesses, by law, they are not obliged to prepare financial statements, but they are encouraged to prepare them. But they are not, it's not compulsory for them to prepare them and audited. But for public companies, as we will see in auditing, I said, public companies, they must be audited, okay? They must be audited. So the audit fees which we pay the auditor, this one is recorded under an expense. Then the directors' fees. Directors, these are individuals who run the company, okay? These directors always we pay for their work and that. So all these, we write them under our expenses, okay? Then we have the trading stock deficit. What is a deficit? Trading stock, I know, you guys, you are aware, this is our daily stock we are selling, but then the deficit. Deficit takes place, for example, let's say in our stock, we expected to have stock to the value of 10,000, okay? Then, when we go to do the physical stock taking, what do I mean here? I'm sure you people, you have seen some businesses, sometimes they say, no, we are closed for today, or for 2 days or 3, we are doing stock taking, okay? Stock taking means they are going to go and they check item by item, they count item by item, item by item, item by item. Then after counting those items, they go to their books and compare, okay, for a specific product, okay? They say, oh, this type of product, to expected maybe we had 1,000 items, but we only have maybe 900 items in our stock. So the book is saying 1,000, but in our stock, we only have 900 items. So what happened to the 1,000 items? So the 1,000 items might have been maybe stolen or damaged or eaten up by rats, sometimes in the store there. Sometimes anything can happen to stock, and then it needs to be decreased. Now, we are looking at the value. If we expected our books to have 10,000 stock to the value of 10,000, and then we find that no, it is only 8,000 stock in the business, which means there is a difference of 2,000 stock. So where is this 2,000? Do you see that we are losing this stock? We have lost it and we bought it with our money. So this deficit here, it's an expense to us, okay? Then we go to depreciation. What is depreciation? Depreciation, you've been doing this since grade 10. This one has to do with the non-current assets, like furniture, equipment, vehicles, machinery, etc. So these items, they always lose value. If you remember, that's what your teachers told you in grade 10 and 11. These assets, they always lose what? Value. So whenever they lose value in the financial year, we call that what? Depreciation. So I will show you when we are doing our question, how do we calculate what? Depreciation. I'll be showing you that. And then I'll show you the different methods of calculating depreciation. You did them, I'm sure, straight line, diminishing balance method, or reducing balance method, or current value method, unit of production method. We shall see this depending on the question they asked you. So depreciation, when an asset loses value, I repeat, it's a what? It is an expense. Okay. Then I already explained this when I was doing this profit on sale of asset, but let me repeat it. We have loss on sale of assets. I said that, for example, if the value of our asset in our books was, let's say, the carrying amount was 1,000. We had equipment and the carrying amount was 1,000. Then we end up selling it maybe 800. Okay. Now, do you see that we have lost? And how have we lost? We have lost because our asset here, remember our book, let's say you have a phone, and your phone, when you check it, since you bought it and its value now, you find that the value is 1,000. You can say maybe you bought it 2,000, but now it has lost a value of 1,000. Now its value or book value is 1,000. Okay. Then I come to buy it from you. Okay. But because maybe you are what? You are stranded, you need money. Then I can take advantage and you say, you know what? I'm going to give you 800. You see that? But you know that, no, your book, your phone is to the value of 1,000. But then you end up selling it to me at 800. So which means you have made a loss of how much? You have made a loss of 200. So this 200, we record it as a loss. This is going to be a 200 what? Sorry. a 200 loss, okay? So this 200 loss, it's a what? It is an expense in our book. So this is be a 200 what? Loss. So ETC, we are saying that we have other expenses. We have other expenses, but as I said, you must record. Don't include the expenses which are not given to you in the question. We only record those ones which are given in the question, like stationery will be there, rent expense will be there, talk about so many expenses, right? Now, after adding all our figures, okay? After entering all our amounts, again, look at this box. The thick line, this thick line, okay? This one, okay? This black line, this one, this dark line. So what do you see? We are adding all the expenses in here, okay? Then we get one figure and we put it where? Here on top. And then we put it in brackets. Putting it in brackets means that money is going out. And then we have to subtract it from our, remember here, we added this plus this, then all our income we have is this, okay? Then we subtract it, we subtract off the expenses, all the expenses, the operating expenses, okay? So this figure we have got is this operating what? Expense. So we get our gross operating income plus minus operating expenses. Mind you, let me take you down a bit here. Our major aim is to determine whether this business made a profit or a loss, right? But we are going through steps. We can't determine, we can't come to this figure without going up here. Sorry, without starting up here, okay? Remember at the beginning I said, I'm not the one coming up with this structure. International Financial Reporting Standards is the one which designed this structure, and they say we must follow this structure, okay? Now, we proceed, okay? We proceed and say, after subtracting off this here, we subtract it from this, then what do we get? You see what I'm doing? The figure we are using here, this figure here, this one, it's coming from gross operating income minus operating what? Expenses. So operating profit or loss. Meaning, if our income is bigger than our expenses, let's say our operating income here, let's say was, let me say 500,000. Let me say, okay, it was 300,000. Okay. No, let me put, okay, 300,000. I'm just giving an example. It was 300,000, okay? And we find that all our expenses are only, maybe we have made expenses of 100 what? 1,000. So this 100,000, we are going to subtract it from the 300,000. And then we get our, operate, then for that case, it will be an operating what? Profit. Because 300,000 minus 100,000, we shall be left with how much? With we shall be left with 200,000. So the 200,000 will be our operating what? Profit here. Remember, I'm just giving you examples. I'm just coming up with my own figures, okay? Now, you see, this figure here is coming from here. But if we make it a reverse, and we say our operating profit, gross operating income was 100,000, and the expenses were 300,000, then we are going to have an operating loss of how much? Of 200,000. So now for that case, this 200,000 will be in what? In the brackets to say that we have paid out more than what we have received. Then, after determining your operating profit, we go down to the next part. Okay? We have interest income. Interest income. when do we receive interest? This one, for example, we have an investment in the bank, okay? If we have an investment in the bank, this bank will always give us what? Interest. Let's say we have a fixed deposit, yes. If we have a fixed deposit, the bank always give us what? The bank will always give us income interest, okay? Because we are always they are using our money. So that interest they give us, we call it the interest what? The interest income. Okay. Then we have, so interest income always comes after operating what? Operating profit. Okay. That will be operating, it comes after operating profit. So, all right. So after recording, after determining our gross profit, we said, and we have determined the interest income, it will be given to us. So the interest income, then we get what? We shall add it to our gross profit, sorry, operating profit. Then we determine the operating profit or loss before interest expense or finance cost. Now, this part is a bit challenging to some students. Sometimes they leave it, this part here, going down. Sometimes they just leave it, they don't put anything there, this part, okay? Now, interest income, I've explained it. Now, profit or loss, remember this one, we are saying profit or loss because you find that here, as I said, that you may find that it's a loss or it's a what? It's a profit. Now, before interest expense or finance cost. So before we paid for interest, so this is the profit. Now, before means that this is what we have before. Remember, the interest expense is under. Okay, is under this figure. Now, if we get this, let's say our interest income was 1,000 rand, okay? It means that our profit before interest expense will be 201,000, okay? Now, then we shall add it after determining this figure here, okay? It will be 201,000, okay? Now, we go to the interest expense itself. Remember, this is before interest expense. Now, we are on the interest expense. Interest expense or finance cost. What is this? Remember, when you get a loan, this is the opposite of this one. This one, we are receiving money. This one, we are paying out money. When you get a loan from the bank, right? When you get a loan from the bank, it means that now, remember, you can't take this loan for free. Okay, they will say, okay, we are giving you maybe 500,000, fine. But every year, we are going to be paying just interest of maybe 10% or 5%. So you will have to multiply that 5% with the full amount of loan they gave you. So that amount, like here, for this case, this 1,000 is the amount you pay every year as no, this one. Let's say we also pay interest of 500 every year, okay? So this one, it's you see it has been put in a bracket here, okay? So it means that we shall have to do what? We shall have to deduct it from our figure here. So this minus this, then we shall determine our profit or loss before tax. Let's say this minus this, it gave us how much? This was 1,000, 201,000, then it will be 20500. 200,500, okay? Now, it means that now we are going to, this is an expense, so this is what we are left with. Remember, this one was 201,000. 201,000, and now this one is 200,500. So it is less. Okay. Now, what do? This is a profit or loss before tax, before we pay for the tax. Okay. Now, remember, a company must pay tax under its name, a company. Okay. So taxation is an expense also. Okay. So income tax, they are saying income tax is subtracted. Yes. When we pay tax, for example, in South Africa, we pay tax and then we pay tax of 28%. So if this is our tax, we shall do 28%. Remember, the taxation here in South Africa is 28% times what? Times 200,500. So you'll get the amount of tax you have to pay. Okay. Let me do my calculation here. Remember, I came up with my own figures here just to assist us do what? Do our calculation for explanation purposes only. So if our profit before tax is 200,500, so we shall need to multiply 28%. Okay, 28% of this will be just a moment. Yeah. Do this. Yes, 28% is giving me, 28% times 28%, it gives me 56,140. Okay, 56,140. I'm just giving you an example. So that will be our tax we are paying. Okay. Now we get our net profit after paying what? Tax. After paying tax, so that one minus 200,500 minus 56,140, we shall get, this is 200,500. We get 144,360. So this will be our net profit. So the net profit which we have here is what is left after we remember we started with getting our income, we removed all the expenses, we have paid tax to SARS. So this is what is left for you, for the business owners to share. Okay. So always, if I take you back, we said, remember I told you that it's a journey. Okay. We start from our incomes, sales, cost of sales, gross profit, then we add on other incomes, we go down, we go down, we go down. So what I'm trying to say is, you can't have this net profit, as I said somewhere, as I just started recording the video. You can't have this figure, net profit, without having your sales. So we start from up, coming down. So this one summarizes the structure of our income statement. Remember, I said that the income statement is something, sorry, it's not new to you. You started it from grade 10, then grade 11, and grade 12. We just add in a few items. For example, the few items, by the way, we have added here, we have added in taxation, okay? Even last time, grade 11, you never did interest expense. Auditors' fees, directors' fees, you never did them. So we have just added in a few items. And then this is a good question. Remember, this is a big question in the exam and which carries a lot of marks. 2, you must be, they can bring it and they tell you to prepare just a part of it. So you must be able to prepare it. So we shall do a question in our next recording on this. Now, if I take you here on the notes here, the notes are giving us